Hey, happy Monday. Alyssa Glutz here over at Cherry Creek Mortgage and Color My Credit. How you doing? Hope you had a good weekend. Hey, I want to talk a little bit today on payments. Payments for the things that you borrow money for. If we're going to buy a car, we usually walk into a car dealership and usually the conversation starts with the salesperson of what do you want your monthly payments to be? What do you want your monthly car payment to be? Or this is what the car payment is I want. And that's kind of how you can get in trouble sometimes because whatever that car payment is, as long as that car payment is something that you're comfortable with, and they can kind of work in all these other things in the based on just spreading it out over more years to achieve that same payment. So the same thing with a house. And the funny thing, 17 years of being a mortgage lender, when I'm talking to someone, they're usually pretty focused on how much do I qualify for? How much am I pre-approved for? And when they say that, they're not asking how much can I afford in a monthly payment. They're asking me for how much of a purchase price. How much can I purchase? If I'm getting down payment assistance, if I'm going to put money down, how much do I qualify for? So that I can put that number in my little filter in my MLS or in with my realtor so that they can set up a search for me and I can start looking for homes in that price range. But wouldn't most of you agree that a house that's $220 might have a totally different makeup, a different payment breakdown than another property that's $220? For example, if somebody came to me, I had one a couple months ago that a client of mine that was working with actually my ex-husband, and they were out and they started out looking at properties that were condos because that's what she thought she could get herself into. And she was around a 180 price range, and we were qualifying her, including, a general kind of a standard HOA payment and the taxes, the insurance, everything. And she's out there looking for condos. Well, when she kind of realized that condos weren't going to be what she could find, what was going to make her happy, she started to focus more on a house. And once she moved in that direction, I could kind of adjust a few things because the houses in the areas that she was looking didn't have an HOA. So, rule of thumb, about every $50, $60 a month in HOA that you don't have now buys you about $10,000 more in purchase price, equivalent to that. Okay, so not having the HOA, and also not, and her being able to not have a condo, which was the property had a bit of a pricing adjustment as it was. Then she was able to get into a house for $220. The same house payment, but it was a $220 house versus a $180 condo. Another one that ran into yesterday, and the clients just canceled on the contract on the property this morning. But solar, I'm sure a lot of you have seen that. I've heard a lot of people saying that solar leased units, that's something to where if you take on the property, you're taking on the lease, you have this extra payment. Yes, it might save you on your electricity bill, but how much is it going to save you on your electricity bill? And in this case, what happened was the clients were buying a home where the sellers had just installed the solar units in July, I believe it was. They hadn't even got their loan put together yet. They hadn't even made the first payment yet. And part of the purchasing of this home was also the clients getting qualified for that solar loan. Not the lease, but the solar loan, which means they had to qualify with FICOs that were okay for a mortgage, but then the main borrower his FICO wasn't high enough, right? And then as it got into it, what it was is the seller was taking that tax incentive, and our buyer was actually exempt from paying taxes. So they had no real tax incentive, tax benefit to owning the unit. And what happens is they have this low payment. I think we figured out it to be about $125 a month for 18 months. After 18 months, they said, then the payment will be re-amortized based on how much you've paid down. So they're assuming that you're going to get the tax incentive by that point, if you have the ability to even get the tax incentive, and that you'll take it, you won't spend it on yourself, you'll apply it straight over there to pay down your solar loan, and then it'll be re-amortized based on this new amount. So when the clients got the actual contract and saw that the payment was going to go from $125 to $185 in 18 months, they were like, well, okay, that's not really exactly what we wanted, but I think we can do that. And then I had to kind of look a little closer and show them, and they're also basing that new higher payment based on you paying $10,000 down on this unit over the next year. Are you planning to do that? No. Well, then that's not the payment. It's gonna be another $100 on top of that. So before you know it, they're buying a property that they're taking on an owned solar unit that might help them with electricity, but they're also taking on the payment. You know, there's a lot of other things. I mean, you might be looking around at houses that are in completely different zip codes, where maybe one zip code, the home insurance in that zip code is kind of high. Maybe it's just considered, it's been considered in a flood zone. So your mortgage company's requiring flood insurance. But all of those things, then they add in on top of what we know as like PITI, right? Principal, interest, taxes, and insurance. If you're not putting 20% down, you'll also have mortgage insurance. If you live in a flood zone, you'll also have flood insurance. If you have solar, you'll also have a solar payment, right? You know, there could be all kinds of extra stuff, and before you know it, you are so priced out of being able to afford that house on a monthly payment. So think about that. I got a pre-approval letter from an agent I'm working with right now, and she said, "You think this is scary?" You know, the pre-approval letter shows the maximum payment they qualify for. But it's general. It's very general. It's very standard. I don't know if they realize it's in a flood zone. There's a solar unit to take over. There's an HOA. There's no way that payment that they state is their maximum payment they can have. There's no way that payment's going to be correct. I'm like, well, you got to call the lender back and tell them to update the pre-approval letter. It could just be something I need to update, but still, you know, talk to your lender about it. If you're only qualified for a certain amount, find out what it is your lender's actually using for a property tax amount, what for property insurance amount. We all internally, we have our own little estimates that we use, but you know, are they factoring into your pre-approval what an HOA payment would be? They might not even realize you're looking at homes with an HOA. They haven't factored in that HOA payment, and that's going to take your debt to income ratio too high. So these are all things that, you know, when you see buying a home being a complicated process, a lot of it is just the strategic planning and this kind of communication, understanding that every house is not going to have the exact, the same house payment. There's a lot of different things that go into it, and definitely watch those solar panels. You know, the least solar panels, you're going to take on a payment as well and never really own the unit. They don't get factored into the appraised value, right? But an owned solar unit that you are taking on a loan, you're taking on payments, they're going to have escalated. They're going to have payments that are going to go up. And you always need to find out what that amount is based on. What's the cap? What's the most that the payments could go up? And not just kind of put it off for another day. So, I don't know. Some things I just wanted to bring up. I think it's important to understand what you're getting yourself into before you signed on the line. I guess that's it. The only other thing I wanted to mention is I always thought it was very weird over in this North Scottsdale Hood area, where Rawhide used to be, if you know that area. In June, they changed the flood map, and the flood insurance that used to be required by mortgage companies if you lived in that kind of Grayhawk area over here in North Scottsdale, it's not required anymore. So you can go, and I'll put a little link below, but you can go to the City of Scottsdale website and you can print an authorization form for them to do a flood determination on your property, and then you mail it to your mortgage company, and your payment will go down because they don't require it. They always say, you should have flood insurance just in case of a flood, but it's not required. And so if it's not required, you could get that removed and maybe reduce your payments. So take a look at that. That's it. Be careful. A condo, something that doesn't legally described as something that doesn't look like it's a condo, could be legally described as a condo. And those condos are one of those things that are, even though the rules are getting easier, there's adjustments to pricing, there's adjustments to interest rate, there's adjustments to all kinds of different stuff that really could have a big effect on the payment that you make. So I hope that helps. If you do want to get pre-qualified for a house, or you are pre-qualified and you just need to try to figure out some strategic ways to get qualified for more or for less of a house payment on the same amount of house, call me. Let's get strategic. And I hope you have a great day. Happy Monday. See you soon.